Welcome everyone to our February webinar. We will be doing this on a monthly basis going forward. Today's topic is going to be 2024. Is it going to be a bumpy year or a promising one? We tried to get a lot of inputs from different economists and different real estate people and different agencies. So hopefully you'll find this valuable. And we'll give you our take at the end, but it's really focused on what are we seeing in the market and what everybody else is saying. Just a general disclaimer about the webinar. This is just intended for educational purposes. There's no legal or financial advice, and we always ask everyone to consult with their legal and financial advisors before they make any financial and investment decisions. With that out of the way, what we'll cover today is the job market. Where is the job market today? Where is it going? The inflation, and what is Federal Reserve thinking about doing this year? What are the key economic activity parameters that we're monitoring? And the financial market as well, and how does that impact the commercial real estate? And then we'll finish with our approach to investments. If you have any questions, like Sammy mentioned, please put it in the chat box. We'll go over them at the end, and we'll have a Q&A session. So starting with the shrinking job market, this is the view of the monthly job growth since really the recovery that happened right after COVID. And it has been a strong job market all along, but you can see the steady decline month over month, and this is up to December. So we're seeing less and less job created, and based on slowdown in some of the big tech companies and the big four companies, but also overall that the labor market demand in terms of new job opening is slowing down, as you can see here. And the unemployment is, yes, it's record low, but it started to flatten. So from what we're seeing is we're going to continue to have a strong market, but we started to see some layoffs. I think last week Baker Hughes had hundreds of jobs slashed at headquarters. The big four were doing some layoffs. Even AI tech were doing some layoffs and job corrections. So overall, the job market is strong, but it started to slow down. Even that there was record immigration, and most of it was illegal in the last couple of years. 2022, I think we had 2 million immigrants, mostly illegal. 2023 was 3 million. But those are low blue-collar jobs, and we still have a shortage of skilled labor in the market overall. And in 2024, it's probably going to continue to shrink from a job growth point of view, and this will show up in potentially more layoffs and slow down on the job openings. When it comes to wages and inflation, what this chart does show is, after COVID, we have this record hike in inflation in the gray line, and the inflation started to go down. The Fed is trying to bring it back to 2%. They hit 3%, it went up again, and they're trying to kind of land it at 2%, and that's why they've been tightening the Fed the interest rate and increasing the interest rate to get this inflation under control. The other lines represents the wages. So the lowest wages will be this dark blue line is for the lower income people, and then the yellow would represent the highest income employees. Overall, you can see that as we started to get inflation, the wages continued to go up, but now we're starting to see a decline, and it's going into steady state. So no more job wages hike anymore. It started to decline a little bit, which is consistent with the previous view of showing less available jobs as well. So overall, the job market is stabilizing, the wages are started to going down, and that's also reflected in the inflation. You can see that the inflation is leading, so it went up faster than the wages, and it's now going down faster than the wages. So from this view, a lot of the economists will say that wages will potentially decline or slow down. And so we've seen the worst in terms of like the wage hike and the inflation hike. And inflation is declining faster than wages, which is a healthy sign of the Fed activity. Moving on to the other indicator, which is the consumer spending and the consumer savings. So if you look at the spending adjusted for inflation year over year, it went up 3%. And this is very strong. It's stronger than the GDP growth. The GDP growth was 2% last year, or 2.5, I think 2.3%. And the consumer spending grew 3% adjusted for inflation. So that's a very healthy sign that the consumers are spending. But it's also outpacing GDP. We expect this to slow down and go back and align with the GDP, which will be expected in 2024 to be 2%. Same thing when it comes to the savings. As you can see, this is a historic chart of the saving. The blue line represents in the saving deposits, and the orange line will show the money market funds. And this was a big stimulus hike of about $3 trillion that went straight into saving and money market. But as you can see, after 2022, both have declined down, which is an indication that things are going back to the norm, the historic growth. If you can see the dotted line in black, this is a historic growth. So we're getting back to that. That it does show us that there's a lot of money sitting into money market and in saving deposits, and they're not being invested. So there's a hesitancy on the investor side to deploy this capital into the stocks or into the alternative investments like real estate or oil and gas. But overall, this picture showing the spending is very healthy, and the consumers are spending, and the savings are consistent with the last since 2011 sort of chart. Another view that is interesting, this is a money market view, which is basically the cash deployed in the money market funds as opposed to being deposited in banks. And this shows us a couple of things. One is there's a record high money sitting in a money market and not being invested, and they're getting the normal 5% right now, 5.5% in the money market. So that's one aspect. There's a lot of cash that is not being invested right now, and people are sitting on the sideline. But the second one is, especially after what happened to the collapse of the banks last year, a lot of people are suspicious of the bank's stability and what's going to happen to certain banks, especially with their exposure into real estate lending and office space and other asset classes, and their investments into high-tech startups. So it's one thing that is there's a lot of cash waiting to be invested, but also it's not sitting in the bank, it's sitting in the money market. So overall, that view shows inflation is getting back under control, consumers are spending, savings are growing. So it's a very healthy view in general. But there are a lot of wild cards that can throw this away, off track. So if you look at what can go wrong, this is a subjective view, and I love Marcus and Millichap research. I've used them a lot, them and CoStar. And what they're showing here is what can go wrong in 2024. Obviously, this is a very subjective view, but the main ones I want to highlight, the risk of AI and its disruption, and the labor strikes are sort of getting managed and under control. So they're showing those in green. They're in stable place. Obviously, the global elections, the election in the US and in Europe and many parts of the world are gonna potentially get things off track or at least introduce hesitancy in the market. The Middle East war and the potential escalation into global supply chain and oil prices. Those are big things that can, even though that the Fed is managing the economy well and they're trying to put things back on track, they can easily get distracted by the fact that these events and the likelihood of happening for those events and the impact of them are real. So the main ones are oil price, as always, geopolitics, and if the Federal Reserve doesn't continue the good work that they have been doing of trying to control the market, if they don't reduce the interest rate fast enough, keep it high for long, or if they actually reduce it too fast, they might actually inject a problem that they're trying to manage. The other factor is the election. So if normally in elections, we have, this is a chart that shows the impact of election years since 1985. So they looked at all the economy factors, election year versus non-election years. And in general, election years have less job growth, less stock market gains, and less GDP growth. And that has been consistent since 1985. So that's a trend. What's different about this election year is, there's a lot of anticipation that this year's election results will be very razor thin, close, and potentially there's going to be a lot of contesting the result regardless of who wins. And what that would do potentially is delay, just delay things. It's going to prolong this wait and see attitude of the investors and say, hey, it's not just the election year that's going to take us to do what historically happened, which is let's not invest as much, let's slow things down until we see what happens at election. This year we might run into, we're getting into 2025 and the election is not even settled yet. So that's the wild card that economists are worried about this year. But overall, it just, that's normally what election year does. It slows down investments and people are just more conservative. So if everything looked really good and the election year is a wild card, the thing that nobody's managing is the debt, is the US debt. And everything that the Fed talks about is managing inflation and jobs and short-term fiscal policy, but nobody's tackling the debt. So this is a view of what's the percentage of debt to GDP. And typically, historically, we've been doing really well until 2007, 2008 is when things got out of control. Even in the 80s, with the high inflation and interest rate, the debt was under control. Even with the introduction of the welfare programs back in the 90s, post 9/11, it really started to pick up in 2007, 2008 with all the stimulus packages, the Trump tax cuts, and then the pandemic free money frenzy. So the projections looks really bad. And, even though 2024, 2025, 2027, up to 2027 looks relatively manageable, nobody's talking about the debt view of the US. And just to give you a perspective, the World Bank normally talks about, third world countries' debt ratio to be sustainable in 100 to 120%. And if you look at the US and being the #1 global economy, and it's hitting, 92, 95%, that's a very bad situation. So it really needs to be sub 80, if not sub 60 going forward. So if we look at the financial market and what does that mean to the interest rate, given the economy view we just talked about, the 10-year treasury is basically the US bonds returns, and that normally is tied to the commercial real estate loans. So in the past 35 years, you see that historically that has been going down and it picked up since COVID. It is estimated to sort of stabilize around 4% going forward. And kind of today, as of today, actually, we're at 4.28 today. So think of this as the basis for all the commercial real estate loans. Add another 1.5% to 2%. That would be your interest rate to buy a commercial property. The CME Fed Watch tool. This is a probability that they're thinking that what's going to happen this year, given the Fed indication and what the Fed is watching. They anticipated that in the January meeting, they were not going to reduce the rate, and that's exactly what happened. Now they're debating that for sure they're going to drop it in May, but are they going to actually start to drop it by 25 bips or 0.25% of the interest rate starting in March, definitely in May. And then the next question is how many times they're going to actually reduce it. The Fed chairman indicated that they're going to probably do 3 to 4. Depends on how the inflation management is going and the job market. But it's anything between 0.75 to 1% between now and the end of the year. Like I said, the 10-year treasury will settle around 4%. The Fed said the target inflation is 2%, and they expect the GDP to be at 2%. And that's why they like to think that the 10-year treasury will be 2 plus 2, which is a 4%, as historically been. So from that perspective, the Fed is saying we are at the top, we are at the peak of the interest, and from now on it's just going to get lower. Now, how many times they reduce it this year and how much is a question that we're going to continue to monitor, but we expect at a minimum 3 drops, if not 4. Another key factor in the real estate financial side is the loans. Typically, the loans of this commercial real estate projects are anywhere from, bridge debt, which can be 1 to 3 years, or permanent debt that can be 5 to 10 years. And what you see here in the chart is the fact that a lot of these loans are maturing, and it's peaking actually in 2024. You can see in the multifamily space, it's peaking. In the hotel and office space, it's peaking. And it doesn't mean that it's necessarily a bad thing, but it means that because of the valuation of these properties are going down, a lot of these properties cannot potentially refinance, or they cannot pay off their debt if they need to close that, if they need to sell the property. So this will create a pressure on the banks and on the owners to either sell prematurely or to try to work with the lenders to modify the loan terms, which is typically that's not something that is common. But given the circumstances of the real estate market and the fact that there's a lot of loans maturing this year, many lenders started to modify their loans, working with the owners. So it's driving a lot of anxiety and panic in many of the properties. But what we're seeing across the board is lenders are more flexible to keep things floating until we get to 2026, 2027. So we don't expect a flood of properties because of this phenomena, like everybody's saying, but we expect definitely an uptick in movement because of people have to refinance or exit these projects. As we talked, there was a record hike. It was the fastest interest increase in the history of the US. It's an unprecedented sort of level of how fast they increased the interest rate to control the inflation. But also, because of inflation, the rent growth across different asset classes was astronomical as well. All have seen how much the apartment rents went up, the industrial as well. So overall, everybody benefited in the last few years, with the exception of office. And what this shows also that commercial real estate is very sensitive to to the Fed movement, unlike any other industries. When there's a stimulus, there's a lot of activity, and where it's tightening, the markets almost shut down. Speaking of market cycles, we like to see, the behavior of the investors and the behavior of the market cycle as the seasons of the year. When it's summertime, real estate prices are going up, everybody's participating. Then they raise the rates, then the prices started to go down, and they continue to tighten them up, the increase the rates until the market bottoms up in the winter, which kind of like to see it as like, say it's like a 6 o'clock. And then once the prices goes kind of to the bottom, they start the stimulation process, lowering the interest rate, and the prices start to pick up, and there's a lot of activity in the spring, and then we hit the summer. So if you look at it from a different point of view, there's a lot of people who will be like in euphoria when it's summertime, the prices are up, everybody's participating, and then the market shifts on everybody until they get into panic and depression, which is like when the market hits the bottom, and then we go through that hope cycle again, and they pick up again. So where we look at the market right now, given we're in the early 2024, we think we're between depression and hope on where the market sentiment is and the investor sentiment is. And then from a seasons clock, we think we're in 5 or 6 o'clock today. Obviously, everybody would like to say we like to time the market. Nobody can. It's never happened. So, but the ideal scenario is to buy at 6 o'clock and sell at 12 o'clock. So if you hit the market right around 5 to 7 and you sell between 11 and 1, then this is the maximum potential. But like I said, no one can time the market, and we just need to continue to monitor the market conditions and change the strategy accordingly. I'm gonna go now into, okay, we understand the economy, we understand the financial market. How does it impact the commercial real estate? I would say that overall the asset classes, things are getting back to normal. You can see in the apartment complexes, this was the famous COVID dip when everybody stopped paying rent and things looked bad, and then the recovery since, and now it's almost flattening. Retail, a similar story, continued to perform better and better, and now it's steady state. With the everything almost fully recovered with the exception of office. So office is not really doing well, and it's going to continue to trend in the wrong direction before it gets back to normal. Another view that you think about, like, interest rate and its impact on valuation of the commercial real estate properties. So the blue line is the interest rate. We were as low as 3% at the peak of the stimulus in 2020. And then the Fed started to raise the interest rate. And you can see, in the 2020 and 2021, the cap rates were still high. We were still at a lower record. So it's still dropping. So the interest was low, it was cheap to buy and to borrow money, and the valuation was also high. And there's a lot of people who bought, high value properties with using low interest loan. But what happens is the valuation started to go in the wrong direction, which is meaning that the valuations are lower and the interest is higher. And what that created is it created this extreme of people overpaid for properties and the interest went up, and now the valuation is going down for their property, so really cannot sell today. So this rapid market shift created this extreme valuation swing, but the good news is it's now stabilizing. So the cap rate and the interest rates are getting closer and closer together, and now things are going to go back to a stable state where the interest and the cap rate is more representative of the market. Really quickly on retail, we don't participate in a lot of retail, but I'd like to show the retail view. Retail has been reconfiguring and recovering for the past 20 years or 15 years. And what you can see here, the orange line is a vacancy, is very healthy. It's about 5.5 nationwide for multi-tenant and 4.5 for single tenant. So let's say it's a healthy retail market. It has recovered, and it's a strong outlook going forward in 24 for especially the suburban growth areas, as this new housing units are being built in the major cities. Office, very gloomy picture, especially for the urban office spaces. It's now hitting 25, 26% vacancy. This is nationwide. It can be worse in different cities. There's a better view in the suburban office spaces that are being built in the last 15 years or so. But overall, office is in a tough space. And the problem with office is not easy to reconfigure or repurpose the office space into something else. You know, shopping centers can be different, you know, can be used for different things, and that's how they recovered. But the office space, it's very difficult to convert office into multifamily or office into some other use case. So overall, the office market is a tough market, and we don't like to participate in the office space. Industrial is very strong. It's been the superstar in the last few years. Demand is very solid. And although supply, everybody was building, the development was crazy. As you can see here in the blue lines, the development and the deliveries were historic high. With all those deliveries, demand is still strong and vacancy continued to drop. And so this industrial space continues to perform well, but a lot of players understand that, you know, that rapid delivery and rapid supply needs to slow down, and a lot of investors are slowing down, are not building industrial anymore. And you can see the demand is still strong on a yearly basis, and that will continue to drive vacancy low. Now, we go to my favorite, which is multifamily. First, I'd like to start with the residential view, which is the housing side. So on the housing side, everybody saw that rapid increase in prices when the interest rate was 2.5%, 3%. Post-COVID stimulus, it went up on average, I think 35 to 36% nationwide. And although some prices dipped last year, for the most part, it's pretty flat right now. So there's one phenomenon that the prices are not really going down yet. The other phenomena is a lot of people bought their houses and refinanced during that stimulus era, and they have very low interest rates on their homes today, 2.5%, 3% across the board. And nobody wants to sell their house unless they have to, or if there's a job relocation or a life event, no one wants to sell their house. So the prices are holding, and the reason they're holding is there's not a lot of houses for sale as well. So that's why you don't see a lot of houses for sale. And if they're a good house, they normally don't stick on the market, and they maintain relatively the high price at so we're not seeing a housing correction. Now, over time, I think this will drop, maybe it'll stay flat. So that crazy increase has already happened and potentially is going to stay flat and drop a little bit. We don't see a housing pricing correction going forward. But what we do see is this huge gap between renting an apartment unit and buying a house. As you can see, the blue line is basically the average mortgage payment nationwide. And the orange line is the average unit rent nationwide. And the gap is historic high. What this does is there's a lot of people who are not able to buy a new home, especially the new first home buyers. And this will continue to drive demand for apartment complexes. So this excites us because we like multifamily, and we believe that the US is becoming like, you know, the rest of the world, more and more of a renter's nation. Unfortunately, for a lot of first home buyers, it's going to be tougher to buy a home. And as we talked about, the houses prices, we don't expect them to, collapse. They might adjust a little bit, but we don't expect them to collapse. So this will continue to show a huge demand for apartment complexes, especially for the younger generation. The other fundamentals we look at, just like we looked at the other things, vacancy and supply and demand. So absorption is what we talked about. There's a lot of demand for apartment units, and it's going to continue to grow 5.5% to 6% year over year. And although there was an uptick in deliveries in the blue line, there's a lot of deliveries that happened late 22 into 23. Demand is still driving vacancy down, which is a good story. The other thing on the rent side of things, as you can see here, the rent in the orange line, the growth peaked up to 8, 10%, even 11%, and then dropped during the late 22 and most of 2023, where rent was relatively flat. In some cities, they went down a little bit. But you can see 2024 into 2025, we're back to a normal steady state, which is 2 to 3% rent growth year over year. So I would say multifamily is back on the right track, and rent growth after a small dip and flattening is started to pick up again, and demand will continue to be a strong story. So multifamily and industrial, we still see them as sort of the top two asset classes to focus on. In terms of the prices for multifamily units, this chart shows how much activity in orange of sales of multifamily, and the blue line shows the value of the properties per unit. So as you can imagine, it was continue to grow on a steady state, and then post-COVID stimulus, there was a huge uptick in price and in sales and activities. And then the price started to adjust, and we're here today. And you can see 2023, there was record low activity of transactions between sellers and buyers, including Q1, still relatively low. But we expect this to bottom up into mid 2024 and into Q3. And that will be the absolute bottom of the prices. So this is a perfect timing to start acquiring properties, basically the second half 24 and early 25. And as you saw from the season clock, I think we're at 5 o'clock, almost nearing 6 o'clock when it comes to multifamily. So we're nearing the bottom, and this is a good time to sort of be back in the market and preparing to do more acquisitions down the road. So overall, my take on the 2024 forecast is generally optimistic, but all economic and market indicators leading that we're going to be stable and we're getting back to normal. The market is going to be in steady state for a while, so investors needs to stick back to the fundamentals. The market isn't going to make people lucky like it did in the last few years. For that, for people who were in the market in the last 5 years, they are still hesitant and conservative, which is a good thing, because we don't see a lot of new investors who are trying to beat the market and shift certain demand and supply numbers. But overall, investors are still hesitant and conservative, but I think they're going to start to move in Q2 forward. Diversification is key. As you can see, not all asset classes are created equal. Not all markets are the same. So focusing on the right assets in the right market and going back to the fundamentals. Like I said, the market is going to be really stable. So there's no upswings and downswings, with the exception of the wild cards I discussed that might throw things away. 2024 is really the beginning of going back into a buying attitude. As I mentioned, I feel like we're nearing that 6 o'clock. We're not there yet, but we're close to it. And so if investors can continue to be selective in their criteria, but they cannot wait too long, because when the market is back, everybody is going to jump in. So we expect a big uptick in activity starting in Q2. And finally, we finished with our approach and invest stream based on everything you heard, and our adjustment to our strategy is a continuous process for us. We're going to continue to look for the above national average for job growth, population growth, and rent growth. We love Texas. We're going to continue to operate there because it checks all these three boxes. When it comes to property types, we've been focused on multifamily acquisition and asset management. And recently, we started to have a few projects in the industrial retail development space. We like to create real value and force appreciation and not rely on market favoritism. Property conditions, we typically look for moderate value add projects. So we buy it at a good basis. We inject capital to improve the property and amenities and tightly manage the operations. And when it comes to interest rates, you can see the interest rates are going to be here and it's going to stay there. So here to stay, nothing going to be crazy. So we're trying to find other creative finance strategies to navigate the capital market and continue to create a win-win situation. Just a little bit about the team. I'm Al Salus. I lead the InvestStream investing firm. We focus on commercial real estate. I worked in oil and gas for 15 years. We had 2 startups and few business acquisitions and mergers. My business partners, Baha and Yusuf from Oklahoma, really, first, they're more than my brothers, they're my cousins as well. Baha is a neurologist and really an entrepreneur in different industries, and Yusuf as well. He worked as a pharmacist and now leading a management consulting firm for medical practices. So we put this together about 3 years ago, and now we're growing the team. Recently had Wes join us. He's from Oklahoma, has been working in the hospitality industries and developed many of his own stores in IHOP and Jack in the Box, and has been working in real estate for over 10 years. And Marquise is our acquisitions manager here in Houston, been helping us on the acquisition side. And then the rest of the team, as you can see here. So some of the assets that we have under management, from multifamily to flex space and industrial, and some of the previous development projects in the IHOP and the Jack in the Box and shopping centers in Oklahoma. We also like to participate in other markets as limited partners and passive investors. Any market that we really like, but we don't have presence in, we like to invest there. And so we have few properties I invested in Atlanta, Georgia, Dallas, and Phoenix. I'll wrap it with that and open it up for question. I don't know, Sammy, if you have any questions on the chat.
You shared this clock about the timing of the market, and you said maybe 2024 we're nearing the 6 o'clock. But usually, how do we know? Like, is this cycle yearly, quarterly? How the clock moves? What is the timelines of the cycles on this clock?
It depends on the asset class, but let's pick maybe multifamily. This is a housing market view. So 2003, 2005, we hit 2007, then everything collapsed. So, okay, this cycle is 15 years. There's no like time period for a cycle, but typically it's a pattern. There was this big cycle, big uptick in inflation back in the 80s. And then economic growth until late 2007. And then an adjustment. And it goes back and start economic growth. Even without COVID, we would have had an adjustment in the US economy because it has been growing since 2009, really. So I mean, if I want to average, it's probably every 15, 20 years. Sometimes it's every 10 years.
Okay.
But there's no time frame to it. But what I would say is
And usually it's similar between real estate investment and let's say stock market, or not necessarily?
stock market should follow that equation, but sometimes there's other factors in the stock market that are more related to like, the way investments happened or the way the market is is punishing or rewarding a specific company. So I would say the stock market, if you look at the S&P side, 500 S&P 500, probably the same. Yes.
Okay. Yeah, thanks for clarifying, for shedding the light on this.
Yeah. The good news is we're already nearing the bottom. So we have like once we hit the bottom, we're gonna have another 10 years worth of economic growth to come.
Thank you for coming, everyone. And if you have any questions afterwards, you can always respond to that email or any of the invites that we sent out. And we're happy to answer those questions after the webinar as well. And then stay tuned for our March event.
Perfect. Thank you, Sammy.
Thank you.
Thanks, everyone. Thanks for
Thanks,
attending.
everybody.
Bye.